Hello and welcome to the Capital Markets Live. I'm Alvin Lam, Managing Director of International Markets at Ginnie Mae. Today I'm joined by Keir Joyce, Vice President and Portfolio Manager in the Fixed Income Division at T. Rowe Price. He managed the U.S. Ginnie Mae bond strategy and a mortgage-backed security multi-sector account portfolio. He is President of the Ginnie Mae Fund and the Executive Vice President of the mortgage-backed securities multi-sector account portfolio, and chairman of their respective investment advisory committees. Keir has more than 20 years of investment experience in fixed income and MBS space. Prior to T. Rowe Price, he worked at the State Street Global Advisors and Lehman Brothers. Welcome, Keir.
Alvin, thank you for inviting me. I'm happy to be here.
Pleasure having you, Keir. We're in a very volatile environment with the major conflicts in Ukraine and Eastern Europe. We all hope the situation gets resolved peacefully soon. Take the geopolitical issues aside. Let's talk about a rise in Treasury yields with the Fed's normalizing policy to a less accommodative stance. Can you give us some perspective on the recent market movements?
Certainly, Alvin. It's been a volatile start to the year, and the trend higher in Treasury rates, with the 10-year rapidly rising above 2% to levels we've not seen since the start of the pandemic, really started back in the summer. The Fed began guiding investors back to less accommodative policy stance with their asset purchases. And I believe what we initially witnessed with the trend towards higher rates was a market gaining confidence that the stagflationary trends implied in parts of the Treasury market were giving way to greater confidence towards improving growth and confidence in the Fed's ability to adjust its policy stance without large disruptions. I would say recently the narrative from the Fed has seemingly shifted with its accelerated pace of tapering. We've also seen the expectations for an earlier start to rate hikes, a quicker pace of hikes, and even an earlier start to reducing the size of the assets they hold on the balance sheet, as inflation pressures may be more structural in nature.
Yes, the Fed has to address multiple issues as always. Let's discuss the implications to the mortgage-backed securities. As the Fed discussed rising short-term rates and tightened policies, what does that mean for balance sheet policy and Ginnie Mae securities?
Sure. The Fed began tapering its daily asset purchases last year. And I would say we've seen an acceleration in how quickly they're stepping away from both the Treasury and MBS market back in December. With expectations for an end of net buying in March, that really clears the way for decisions on the magnitude of an initial hike we'll see coming up. So regarding balance sheet policy, the Fed's holdings now total $2.7 trillion in mortgages, and they hold at least 30% market share in the sector. We put up a slide to show that growth in the balance sheet during the QE4 period. The size of their holdings has drawn a lot of attention towards an earlier start to letting the balance sheet roll off. And that's usually by means of reinvesting paydowns or letting holdings mature. After the Fed tapered its QE3 purchases in 2014, there was a period of 12 months before the Fed began raising rates, and then another 2 years before the Fed started letting the balance sheet decline. So for the Ginnie Mae market, we've seen mixed performance in this environment, and we're really debating the uncertainty around the demand for mortgages, which is offset by an improving fundamental backdrop for the sector and some relief on the supply front with higher rates.
Thank you. That gave us a very good framework to continue our discussions. We have very different challenges today comparing to 8 years ago. What are the policy expectations today, say 2022?
Yeah, as you mentioned, we're certainly in a different environment than we were 8 years ago. I would say policy expectations today are remarkably different. We don't expect there to be a lag between the end of tapering and the move in short rates, as well as balance sheet contraction beginning as soon as the summer. Both actions reflect a Fed that's attempting to communicate the need to be nimble and data dependent in adjusting policy. And that's a change from a more gradual approach during prior QE periods. So back in January, this idea that we could see an earlier start to balance sheet runoff was confirmed when the Fed provided us with an update to the planned principles approach for reducing balance sheet. I will say, however, at the time, Chairman Powell also expressed that those important decisions regarding balance sheet have really yet to be decided. That's somewhat consistent with the talking about tapering approach we heard from the Fed back in the summer, and they were prepping the market for a policy shift back then. That transparency is a big difference, and one reason why the Ginnie Mae sector has not seen a repeat of the large drawdowns we saw back in 2013 during the taper tantrum.
So, Keir, do you expect different policy actions from that can impact the Ginnie Mae market?
We certainly do expect some difference in policy actions. And we talked a little bit already about the differences that we've seen in expectations for an earlier start to QT. And with the balance sheet much bigger, there's speculation that further down the road, we may likely see active sales in the mortgage market. Recently, Federal Reserve Bank of Cleveland President Loretta Mester, and she tends to be a little bit more hawkish on policy, spoke about supporting active sales later in the balance sheet wind down. So balance sheet runoff has mainly been a passive policy approach in the past, and active sales are something we haven't seen since the Treasury unwound their MBS holdings back in 2011. I will say that the Fed has certainly demonstrated their maturity and nimbleness as an investor in the sector over the years. I would expect them to continue to be mindful of the market impact of their actions as we move towards an earlier start to balance sheet contraction. Given the sharp move in rates and the concentration of lower coupons in Fed holdings, paydowns might well fall short of their desired monthly roll-off caps. So this idea of sales might present an opportunity for Ginnie Mae investors as the Fed looks to support a functioning liquid market. The upcoming Fed meeting in March is going to provide us with more clarity on that. We'll get release of those minutes in early April, and we'll certainly be able to frame what the decisions about balance sheet policy are going to be in the future.
Thanks for sharing the thoughts on the Federal Reserve's actions, and we'll be certainly closely observing their March meeting. Let me ask, how have the market moves impacted the Ginnie Mae market and the potential future performance?
Yeah, it's a great question. If you think about last year, 2021, there was a lot of uncertainty in the market, which was clearly reflected in the performance of the sector. I would say the best way to characterize what we're seeing right now is really renormalization to a more appropriate valuation level. We had a large uneconomic buyer with the Federal Reserve buying $40 billion a month in agency MBS. We also had elevated prepayment uncertainty that was a large risk for investors who wished not to compete with the Fed in their bond buying program. And that led people to focus on other areas of the sector where the Fed was less involved. I believe the sector is adjusting to the Fed's smaller footprint in the market in a more appropriate manner as they taper their monthly purchases of agency MBS. And that speaks to a normalization in the valuations that has pushed spreads wider. So spreads for new origination have widened roughly to 80 basis points versus Treasuries, which is higher than levels we saw back in 2018 when the Fed was last reducing the size of its MBS holdings. Likewise, if we measure valuations in terms of volatility or option-adjusted spreads at 24 basis points, those levels are now more consistent with longer-term historical averages.
That's great. Thank you. How do you see the impacting the broader Ginnie Mae market then?
Yeah, there's a lot of moving pieces. And I guess from one perspective, the move has not been disruptive to the broader Ginnie Mae market, as the rise in Treasury rates did not coincide really with a sharp spike in expectations for interest rate volatility. And we also didn't see an increased hedging in positions that typically can lead to larger underperformance like we saw during 2013 and the taper tantrum. I would say instead, it's really been credit that's seen worse performance than mortgages. And I think that really highlights the liquidity benefits of the Ginnie Mae sector, as well as the underweight positioning by investors. The move in Treasury rates has led to a noticeable rise in mortgage rates consumers are seeing, and we're certainly seeing mortgage rates back to pre-pandemic levels at this point. That rise in rates is dampening supply at a time when the Fed's slowly buying a smaller and smaller number of mortgages from the market daily. So really, we seem to be finding a balance with a market in transition.
We see mortgage rates have risen, but can you provide some perspective on the normalization in valuations that you just spoke about?
Yeah, it's been a clear focus for us, and the normalization in valuations is really illustrated in the premium that investors like us are compensated for on top of the duration and curve risk that we see in the U.S. Treasury market. For us, there are several ways to think about Ginnie Mae valuations as an active manager. While the importance of valuations versus Treasuries is a key benchmark for us, I'd also highlight relative valuations versus other investment grade sectors is increasingly important, and it's really overlooked at times and underappreciated. Relative valuations versus real yields versus corporate sectors with a similar credit rating versus conventional Fannie Freddie MBS risk, or even on a currency adjusted basis, look increasingly appealing in this current environment. I would say those relative perspectives help push back on the idea that QT is just a risk to the mortgage market, as we would expect to see a natural move by investors to higher quality parts of the market as private investors step in to replace the demand by the Fed. This is basically the portfolio balance theory in reverse.
Thank you for those insightful information about the valuation. Can you provide some examples then of the points you just made?
To highlight some of those points, I would say that intermediate AA rated IG credit offers only a small premium to treasuries, and that's still at historically low relative levels to Ginnie Mae's. In this environment, you can pick spread to own a government guaranteed MBS security. Another example is dollar prices between comparable conventional Fannie Freddie TBA to Ginnie's appears more asymmetric to the upside. And we compare that to the respective dollar prices that Ginnies are trading at here. One other perspective would be that real yields out to 10 years are negative. So mortgages offer a historically wide yield advantage to TIPS. And finally, I would add currency adjusted yields near 6-year highs can be supportive for the sector with attracting foreign buyers to the product.
You mentioned rise in rates and the impact on mortgage valuations. Can you talk a little bit about the secondary impact on housing from the moves in the market and what that might mean for the supply-demand trends in the market?
Certainly. It's been a very volatile start to the year, and rising rates in recent weeks have most likely added to an affordability problem with housing that had existed prior to this move. We've seen a 70 basis point rise in Bankrate.com's FHA national average rate since mid-December. And to put that in perspective, the move in borrowing rates has increased monthly payments by over 9%. So that makes the cost of borrowing for housing a much bigger pinch on the consumer, as well as lowering aggregate measures of refinance risk in the sector. Some of that consumer pessimism regarding housing affordability is reflected in a Fannie Mae survey that showed only 25% of respondents thought it was a good time to buy a home. And that's an all-time low. We're also seeing a beginning to the impact of these higher rates with a shift in the consumer's view on housing, with daily supply of mortgages trending lower by as much as 30% from early January by one estimate of average origination we track.
Great points. We discussed the focus in the market on the uncertainty of Fed balance sheet policies. But can you share any perspective from an investor regarding housing policy risk directed toward affordability?
I can. And back in December, the U.S. Senate confirmed Elena McCargo as the new president of Ginnie Mae. In her testimony before the Senate, she emphasized the need for a stable and affordable home ownership. So with the surplus, the Mutual Mortgage Insurance Fund, or MMI, as it's called, is currently positioned with expectations for some cut in the mortgage insurance premium, or MIPS, really have been debated by the market, and that policy decision is still a risk that hangs over the sector. I would say that at these higher interest rates, any MIP cut is less of a concern to raising the prepayment risk we try to model. And there's certainly more suggestions towards targeted relief to mortgage insurance premiums that have recently been floated. And that can be less disruptive to the mortgage market and balance investor concerns about that lower MIP premium, while still helping to address growing housing affordability issues in the market.
Oh, thank you all. Your excellent views. And of course, thank you for reminding us that housing affordability is a priority of Ginnie Mae President Margot, was the first woman president in Ginnie Mae's 54-year history. Wish we had more time here. Thank you for joining the Capital Markets Live.
Thanks for having me. I've enjoyed talking about the sector and hope some of the points resonate with your listeners.
That was Keir Joyce, Vice President and Portfolio Manager in the Fixed Income Division at T. Rowe Price. If you enjoyed this podcast, be sure to subscribe our future episodes of Capital Markets Live on YouTube. If you have any comments or suggestions about today's episode or other topics, please send us an email at ocmglobalinvestorinquiries@hud.gov. Again, the email is ocmglobalinvestorinquiries@hud.gov. Thank you for listening. I'm Alvin Lam, Managing Director, International Markets at Ginnie Mae. Until next time, have a great day.